People always say that you have to have money to make money, and that there's an extraordinary level of sacrifice on the road to success. So how is it that investors like us who didn't start out with much money and who don't rely on banks and credit, how is it that we can increase our income and build our wealth in a way that doesn't require us replacing one full-time job with another while still enjoying the things in life that matter most to us? That has always been the big question, and this podcast reveals the answers. I am Carrie Lake, and this is the Investor Warrior. Hey.
That's such an awesome video.
Welcome to the Investor Warrior show. This is a live stream today. So if you're watching this on the live stream, go ahead and ask your questions, because today I have one of my people. I get real excited when I can bring some of my people on board here. And today I have one of my favorites, Sean Dimercurio of Dimercurio Associates. And Sean is our CPA. He's also our really good friend. And we talk, I don't know, every time I get on the phone with you, we end up talking like 20 minutes of life and then like 10 minutes of taxes. And that usually concludes our 30-minute call.
A little mini therapy session in there too for each of us. So yeah, definitely.
Yes, absolutely. We've talked each other off the ledge, I think, a few times on certain things. And because we both have kids and we both have lives outside of our businesses that we are running. And I don't know, life can get a little bit chaotic sometimes when you have both kids and partners and businesses and all kinds of good things mingled into one.
Yep.
So, yeah. So anyways, you guys, I wanted to bring Sean on here because, gosh, how long have we known you, Sean?
At least 5 years, if not more.
Yeah. Seems like a lifetime ago we met.
Seems like a lifetime, yeah. It's a strong relationship.
It is. And it's so funny because my husband had gone through, I don't know, how he's probably had like 20 CPAs in his lifetime. If you can imagine that. He's also moved around a lot before I met him. But you are by far like the best CPA we've ever worked with. The best, I mean, I think of like the Dos Equis guy, like the most interesting man in the world. You're like the most interesting CPA in the world. Because you're actually fun to be around, but you're a CPA.
I feel like the Dos Equis guy is cooler than I am, though. Like, I just do numbers. He's actually like at a party with a beer in his hand, you know?
Yeah, well, he definitely has a better beard and hair than you do. I mean, you just can't pull off that beard like he can, and that makes him really cool. And yeah, the drinking of the Dos Equis. But I will say that you're like the most just fun. I don't know, the reason why we love working with you, aside from you're an expert in taxes, especially real estate taxes, but that we feel comfortable going to you. And sometimes we just like need to talk things through, because we do sometimes complicated or complex real estate transactions. And sometimes we've got to like think through things to make sure that we're taking advantage of the tax situation. And we're doing this to the best of our ability and to our benefit, right? And sometimes we feel like we'll
other things. Yep.
What's that?
And that it doesn't impact other things in your lives. Sometimes as business owners and investors, we get so focused on deal A that we're not thinking about, well, wait a minute, there's deal B, C, and D, and this could impact that in an unknown way because we're so focused on deal A.
Right. So I think like a CPA is one of the most important people on your team when you're a real estate investor, because it's not always about making money. It's about the money that you can keep and not hand over to Uncle Sam at the end of the day.
You're not so silent.
Stay out of hot water, right?
Yep. Uncle Sam is our not so silent partner that we all have in our business, whether we like it or not.
Yeah, I like that. He is a silent partner. He just likes to take.
Yes.
But you know, it's all for good reason. I'm going to say that paying taxes is not a bad thing. I get sometimes annoyed when I hear people say like, oh, I had to pay this big tax bill this year. And I'm like, well, that means that you made money. Like people are always like, oh, I just want to avoid paying taxes, or I want to get my taxes lowered, or like, I don't want to make that much money because then I'll have to contribute more to taxes. And I'm like, well, but you should be netting more at the end of the day, even though you're making more, if you have a good CPA.
Yep. Well, and I always laugh at the concept of where we have people that'll say, I want to spend money to not pay taxes. And I go, using like easy numbers, if you're in the 40% tax bracket, if you spend $1, you saved 40 cents. That's great. But if you just pay the IRS the 40 cents, you got to keep 60. Like you're still up.
Right.
Say as if you needed that thing that you wanted to buy. But if you're just spending money to spend money, like it doesn't make sense. It drives me crazy. Good tax planning helps people around those situations.
Yes. And so that's what we do with you. We not only make sure that the transactions we're doing are going to be the most favorable tax treatments, but we're always like looking ahead, right, with you. And so planning is huge too. So first off, let's just talk about like what's going on in the crazy world of taxes right now. And really no one knows exactly what's going to go on. So you guys, this is all in theory. This is all like talk right now, and nothing has, not to my knowledge, has been implemented yet, correct?
No, it's going to be really tough for them to get a full bill through. Like if you really think about it, they have the House, Democrats have the House, and it doesn't matter what political party you're affiliated with, Democrats have the House. They'll be able to get a bill passed through there. It's the Senate they're going to have the problem with. They'd have to get all 50 Democrats plus the vice president and a certain number of Republicans to agree to the bill to have it passed unanimously with no edits. We know that's not going to happen. So we definitely know this is going to be the blueprint for the plan. Who knows what it's actually going to be when they're done with it? There's going to be a lot of negotiations, and I'm sure some backdoor deals, silent deals that are happening behind the scenes that we don't know about to get this thing pushed through for what everyone wants. There's
backseat deals? And
I mean, who would have thought, it's not all fully transparent. No, never.
What?
Never.
Shocking. So, okay, well, let's just talk about some of the things that they're proposing as part of these Biden tax law changes.
And I think the interesting one is I'm looking down because I actually jotted down some notes because there's like 4 or 5 big things that I think everyone really should be aware of that's happening, especially if you're on the real estate side. A couple of these really hit you guys. But the first one is the whole thing's designated or designed if you make more than $400 a year.
Mm-hmm.
So that's $400 everything, capital gains, ordinary. We'll talk about that, I think, in a minute. But all that stuff. So when that's more than 400, that's what it should be impacted by, right? But what I remind people is if you sell like 2 or 3 big real estate deals in 1 year, you're probably going to be over 400 grand. Mm-hmm. If you own a business and you sell your business in a year, you're probably going to be over 400 grand. If you invest in a bunch of other deals and they all have a great year, you're probably going to be over 400 grand. So just because you don't always make 400 grand doesn't mean that this whole thing can hit you, which I think is really, really interesting. At least to me, I think it's just amazing.
Let me ask you this question, and you might not know the answer to this. If I were to sell a bunch of properties right now, and I'm making over 400 this year, but I'm selling them right now before the tax laws go into effect, can they go back? And
I used to tell everyone I've never seen in my life them retroactively change something, and then this past year is the first time they did it, where they went back. I've never seen them retroactively change a tax increase though to before today. So I've always seen them say it's coming on January 1st. I've seen them enact laws on December 27th that start 3 days later on January 1st, but I've never seen them go back to January 1st of the current year. So what we're telling investors and what a lot of big firms are telling investors is if you want to get out of the deals, get out of them now, but really think about what you're doing, right? The taxes are always going to go up and down. It's how do we plan through this? And we'll talk about installment sales, but installment sales are a way to spread that capital gain over a couple of years to drop your tax rate. So that's a really effective planning tool that you could literally do at the end of 1 year and the beginning of the next to get where you want to get and save a crap ton of money.
Yes. And I'm excited to get into the installment sale because this is going to work on both sides, you guys. As investors, we're going to be looking for opportunities to help people through these potential tax consequences. So you could potentially purchase properties on installment sales where you're actually helping the homeowner with these tax consequences that they could be facing.
Yep. And it happens a lot. You see it often where you have, I call it the old guy in the middle of the woods, but I've seen so many people like you that come to us and go, There's this guy and he has a trailer in the middle of this like 50-acre piece of property we're trying to buy, and he just doesn't want to pay taxes on it. He'd rather leave it to his kids because that's cheaper to him. And I'm going, there's ways around this. And when there's great investors like you, they'll go, let's be creative and solve his problem so that we can buy the property. And usually that's done through taxes.
Yes.
So it's really, really interesting.
So let's get back to the Biden tax laws.
So there's the piece.
Over 400,000.
Over 400,000. We're going to start with that one. Here's the fun one that I think is going to impact all of you. You've probably heard 1031s are going away. 1031 exchanges are just gone. In the plan itself, though, and so we know what a 1031 exchange is. I think all of your viewers or your listeners know, but it's literally selling one piece of property, buying another piece of property, and you're deferring the profit so you don't pay taxes on it. So in the current plan, if you do that for any deals under $500,000, you're okay. If they're over $500,000 in profit, they're gone. You don't get it. I don't know if it's in total. So if you sell 3 for 400 each, my gut tells me, nope, sorry, you sold more than $500,000. They all get yanked in and you're going to have to pay the tax. But it's also something to really understand with the 1031 exchange rules. They're not saying they're going away. They just don't want them to impact really big investors that are selling $1 million plus pieces of property. We had someone 4 days ago sell 3 properties for, I think, $10-12 million. They're deferring a massive gain and they're going to go buy some more properties by December. They have longer, but they're a little scared about that Biden tax plan. So we're trying to get the whole deal done this year just to be safe.
So if I were to sell a property, I made $500,000 on the deal and I 1031 exchanged that into a $3 million deal, it wouldn't affect me because the gain was only $500,000.
Bingo.
Okay.
You go into the new deal, and then even though you paid $300 for tax purposes, we say that you paid $2.5, so that when you eventually go to sell it, you pay the gain later. Now, if the plan enacts and they actually do this next year, and you sell that property, you can't 1031 it. It's worth the gain. Hopefully, would be worth more than another $500,000, right? Okay.
We have a couple questions, but I'm going to hold off on the questions, you guys, until we get through this first piece, and then you can ask your questions. But I see them, so we'll get to them.
How cool. The other big one that I think people should be aware of is capital gains rates. So right now, you either pay 0, 15, or 20% as your capital gains rate. Depending on what your overall tax rate is, you get this preferential rate, right? Which is beautiful. If you're paying income taxes at 37%, you get to pay capital gains at 20%. If your total income is over $1 million, the rates go away and you pay the 39% rate plus the 3.8% tax rate. You're going to pay over 40% taxes on that deal. This is where installment sales come in really handy. Like you were just saying, if you sell that one deal for over $500,000, let's say it was $501,000 in profit, you have to pay taxes on it. But holy crap, 400,000 is our number. If we can figure out how to spread it over 2 years, now we're going to lower our tax rates and hopefully be underneath the $1 million amount. So at least we're paying a top rate of 20% and not 40+% on the same thing. Does that make sense?
Since we're on the topic, let's go into an installment sale. So what is an installment sale?
I keep playing them up.
Because I already hear the wheels spinning with the listeners. They're like, okay, this all sounds really interesting. Like, what is an installment sale and how do we defer taxes with an installment sale? And what is this 2-year period?
Yep. Installment sales are really beautiful. So in a nutshell, an installment sale is this. Carrie, you have a wonderful piece of property and I want to buy it from you. There's some tax issue, whatever. We agree to owner financing. I'm going to pay you so much down. I'm going to pay you so much a month or so much a year for a period of time. An installment sale is literally that. It's a payment plan over a period of time. But we've all done these when we bought our houses. We have mortgages and things like that. But here's the key. When you're selling a capital asset, like a building, the gain is taxed following the cash flow. So Carrie only pays tax on that deal when she gets the cash from us, not all up front, which allows her to defer the tax over a period of time. So what we've seen some investors do is if they're selling something in, say, November, what they'll do is they'll get half the cash in November and half the cash in January. Now you're in 2 different tax years. So they're in essence managing their tax rates by pulling everything down, and they're going to pay a portion of their tax in one tax year and a portion in their next tax year. The key for installment sales, and this is really, really important, there has to be interest stated in the agreement. If it's not, you could lose the installment sale treatment. Pretty simple. And we see it a lot with investors, not over 1 or 2 years, but over 5 or 10 years with its owner financing. And it's someone like my old man in the middle of the woods example where he just doesn't want to pay the taxes. He's totally fine getting those payments over 10 years. Like that's the deal you want to find, right?
Yeah. So, and let's talk about, so when we do owner financing as an investor, I'm giving a mortgage payment to the previous owner who's now holding, he's the beneficiary of a new note, and I'm the maker of that note.
Correct.
And I'm giving him mortgage payments every single month. And those mortgage payments are broken down into principal and interest, but they're taxed differently, right?
They're taxed differently. So the interest, which hopefully is a lower interest rate, is taxed at your ordinary interest or tax rate. And then the principal is bifurcated. It's split. Part of it is profit, which would be taxed at your capital gains rate. And part of it is return of capital, which is just your money. You get to keep it.
Right.
Or in essence, you could say it's basis in the property. Let's not go into those complicated words, but that's the piece that it is. So it's whatever that rate is. So let's make it really simple. Let's say that your gain was 20%, not tax rate, like you made 20% on the deal. Well, for every principal payment you receive, 20% is taxed. The rest of it's not.
Right.
Make sense?
Yeah. And then let's say we had a 10-year period of time, he'd basically be deferring his taxes over that 10-year period and effectively lowering his tax rate because he's getting them in small chunks, that money back in small chunks.
Bingo. And I've
so not
seen
only
in deals,
is he deferring it over time, but he can actually lower the tax rate.
Bingo. So after taxes, he's getting more and more money in his pocket, which why wouldn't anyone want that? You have the flip side of that, right? Where there's some risk associated with the deal. There's some other stuff too as his side, but obviously he's doing owner financing because he doesn't want all the cash up front. Yeah. He wants to do this type of deal. It's a beautiful deal to do. And if you get to know the people really well, you can always adjust those out so that if he has a tax issue this year, you can pay him a little bit next year.
Yeah.
So that's the relationship side.
This type of transaction works really well, I have found, with people who are getting into their elderly age, where number one, income is really important to them. So getting those, not only the principal back, but interest on their money where they can now use that for their income versus tapping into all their principal. And then number two is, the tax advantages.
Correct. Yeah. And theoretically, you hit a great thing. They're not earning a W-2 those years anymore. So now it's driving their tax rates even lower. They might be in that prime 0% tax rate, that preferential tax rate, where now it's a beautiful thing. So it's a great planning tool. And from an investor standpoint, it's a great negotiation tactic as you're working with someone else trying to buy a piece of property that's, the family doesn't want and the person doesn't want it either.
Now, you guys, I probably should have given this in the beginning, but full disclosure or not disclosure, disclaimer is that I'm not a CPA. This is why I've brought Sean on here to give tax advice. And as an investor, when I'm talking to homeowners, I am never giving tax advice. But what I can talk to them about is, in my experience, this is how it works. And you need to talk to your CPA about your individual situation. But what you should ask him is about this installment sale and whether this will defer your taxes and lower your tax rate. Because in my experience doing this with other homeowners, this is how we've been able to structure it.
Correct. And if you have a really good CPA as the investor, and just like our relationship where you'll call me and go, this is the deal. What ideas do you have? Well, great. Hey, Carrie, here's the 4 things that I think you should mention to this guy and say them exactly like this, because CPAs were a little boring. Maybe not me, but the rest of us, some of us. A little boring, a little whatever, but you start learning how their CPAs think so you can say the exact words for that person to tell their CPA. So the CPA goes, oh, okay, that makes complete sense. Yeah. It's all about marketing and trying to push that piece through. But you're right. And that's really helpful when you have a good CPA on your team to help advise you on what to say to push these things through.
Well, and it's really, really important, you guys, to know the concepts of what we're talking about, because there are opportunities out there where you can take these concepts and you can really help other people who don't understand this stuff. And we don't have to know it all. That's why we have CPAs on our team who are going to give the tax advice. But conceptually, if I can understand the transaction, I can understand what the homeowner is trying to do and what their goals and objectives are for tax planning, then now I can create this transaction that might favor them with their taxes. Exactly.
100%. I love installment sales so much. They're such a great tool. And they're not used often enough either. So I love them.
All right. So let's get back to, now that we've covered installment sale, what are the other things that you had for the Biden tax changes?
Other 2 big things or 3 big things. I don't think this first one's going to impact everyone, but the top tax rate's going from 37% to 39%. It's only 2%. I say that because if you're making $1 million, your taxes are going to go up by something like 20 grand. Hopefully that's okay with you. If you're making $1 billion, that's a whole other ballgame. So we'll throw that one in there. Here's a fun, quirky one for anyone that has a paycheck that's more than $140,000. So the current rule is if you're making up to $140,000, your Social Security tax is 6.2%. If it goes over that, you don't pay it anymore. You're done. And it's a really good tax planning thing that we do with S corps. If you make more than $400,000, the Biden tax plan says, sorry, and they tax you that 6.2% on every dollar of your paycheck. So it's really going to start hurting people. It's not designed for people that are real estate investors because you're working with your CPA, you're working to keep your paycheck below that 140 number and taking distributions and different tax planning things. It's going to hit the millionaires that are making, or the people making over $1 million a year in paychecks. I bring it up just in case because I have seen some real estate investors that take their distributions as W-2s. So I just want to bring it up just to say that I said it.
Yeah. Okay.
That's the big piece. The last 4 things are just really cool for people because I think a lot of your viewers probably can do this. They're increasing childcare credits, they're increasing tax credits, and they're trying to figure out how to fund 4 years of college education for your kids.
Really?
So I think that's going to through a tax credit. Yep. So I think that's really interesting. So that's why are we taxing all these people with all this extra money? It's to pay for all these things like increased childcare credits, increased tax credits, increase of this funding for instead of 2 years of 4 years of some of these college programs. So it's going to be interesting. But I think the biggest pieces for all of your viewers, like we talked about, was that $1 million number doesn't seem like it's big for the capital gains rates, but it could hit people really, in 1 year, you sell a bunch of stuff, it could hit you. And also that change in the 1031 rules, I think is really important too, because when we have a really good year and you're selling a lot of properties, you can get slammed with all this stuff at once. It's where the tax planning piece comes in of going, hey, Sean, we're getting ready to do these 4 things. Can you kind of tell me what this is going to look like? Sure, let's run the numbers and let you know.
Have you also heard of them making any changes to the homestead exemptions?
I haven't, but that'd be at a state level, not at a federal level.
Not the homestead exemptions, the tax credit that you get on your primary residence up to $250.
I haven't heard them say anything about that one yet. So you get $250 for a single, $500 for if you're married, which is wonderful, except if you live in California and bought your home 30 years ago and you're selling it for millions and millions of dollars. So we've seen that happen a lot.
Well, then they also have that crazy grandfathered tax situation in California where
it's the worst. California is the worst for taxes. So is New York, Pennsylvania. There's a couple states that are just a pain in the butt. But
so we're currently selling a house in Rhode Island. And I've been on the phone a lot with Sean these last few weeks, more so than usual. And oh my gosh, you were making me laugh the other day because I don't know, we were talking through the next hurdle with this house. And I don't know, the way the way that Rhode Island does things is just kind of weird. In my opinion. And you were like, okay, after this, can we please agree that we are never going to buy real estate in Rhode Island after this? And I was like, yes, understood.
I'm like, Florida, check. That's it. You don't need to go ananywhere else. California's okay too. But
no, we're not going to be buying any more real estate in Rhode Island after this sale. Because it's just been
it's so many.
Yeah.
And it's not even tax issues that are the primary nightmare. It's just there's some tax stuff, but there's also these other rules that they have that they make you spin. Yeah. And the attorneys up there don't really consult you or walk through it. I want to write a blog article just for people in Rhode Island of how to sell your real estate. It drives me crazy.
So, all right. But we're supposed to be closing today. So
I'm excited.
We'll see. All right. So let's get to the questions here. Before I move on, we did have one question from Alicia. She's a wholesaler. Should I do paperwork for a C Corp to my LLC? Is the EIN number the same as your tax ID number?
We need clarification on what that means.
Yeah.
I'm not sure.
Paperwork for C Corp to my LLC. Okay.
Yeah.
Alicia, can you reword that?
Yeah, reword it and send it, and we'll get an answer for that for sure.
Okay. All right. So let's first talk the basics. What's the difference between ordinary income and long-term capital gains, and when does each apply in real estate?
So I like to overly simplify things. So just remember, for every word I say, there's 15,000 exceptions to that word because the Internal Revenue Code is we actually just got a copy of it. It's like that. You can't even see it's that thick. It's huge. It's crazy.
This is usually why CPAs are super boring, because you have these big tax manuals that you have to understand. But this is why I love you, Sean, because you can understand it, but be fun at the same time.
I meant to tell you this. We were laughing. They sent us this and we're like, we subscribe to this online. We don't need this. So the company gave us a credit back for it. We don't know what to do with these big books. So I decided we're going to rip the pages out and crumple them up when we send gifts and things to clients and use it as packing paper inside of their thing. So they open it up, there'll be a piece of the code sitting in front of them.
That's very earth friendly and very creative.
There you go. See, we're trying. We're recycling. Here's your biggest thing to understand between the two. It's so simple, right? Ordinary income is income that you earn by doing something. So think about doing something with your hands. Both of us are employed. We're working right now doing this. Our W-2s are ordinary income. But if we're flipping houses, using a real estate term, that's ordinary income too. Because even if you directed someone to do something, it's still you're doing something. Capital gains usually are driven by passive assets. And I know, Carrie, you'll laugh at this when I say a rental home is a passive asset. It just sits there. We all know that's not the case. But by definition, it's a passive asset. So when we sell a rental home, when we all understand part of the gain might be subject to some depreciation recapture. Let's pretend that doesn't exist. It's a capital gain. I sold something that I bought for an investment, and that's what it is. Another good example of that non-real estate is a stock. I bought a stock for $100. I sold it for $150. It's a $50 capital gain. I didn't work for it. It just sat there. So ordinary is how we earn our money. Capital is that passive stuff where we're investing our money.
Yeah. And in order to get long-term capital gains, what are the rules?
360. So it's 1 year plus 1 day is the rule. So 366 days. Be careful. I know some people will go, oh, I can just do this. This is great. And on leap years, you got to be really careful on how the code works. Because I've seen people try to sell a property exactly at the 1 year mark. We're like, no. Add the 1 day. Like, just be safe. The IRS might never come look at you, but you don't want to be the one person on a leap year issue that they did. So fun, random little fact, but.
Yeah. And does the house have to be rented the entire time to get long-term capital gains?
As long as the purpose. So this is where purpose comes into play in real estate a lot. You have to understand what the purpose is of what you're doing something with. And a lot of times, and I've seen this happen so many times, where we buy a house to flip and we go, wow, this could be a rental now, right? Our purpose changed. I've seen it happen the other way around too. And it starts getting a little complicated, but It's all about what was our original intent? Why did we buy that property? So if I bought a rental house, great, that's fantastic. And I plan on renting it, fantastic. If I leave the house sitting there for a year plus a day, the 1 year mark, we'll call it 1 year to be easy, you get cap gains treatment on that house. But if you were trying to market that house to sell because it was a flip, you're not going to get cap gains treatment, right? Because you weren't trying to do that. And that's where we talk about entities and where we put our property or assets. There's a reason we do that. This is it. But it's all about intent. And don't think you can't switch them. You can. It's just you have to make sure you document things correctly. And this is where a really good CPA comes in handy, because a lot of real estate people might not take the time to write a note to themselves and put it in some file, where we have files upon files upon files, and we'll write a note about that asset in case you get audited to help protect you on that.
Right. So let's say I have a house that my intention is to flip it. We go in, we start doing work, things get delayed. Now all of a sudden our 6-month renovation took a year, and then we put it up on the market. I can't get long-term capital gains because my intention was always to flip it, even though I've owned it for longer than a year. Correct.
And the best way to think about flipping, I always call it the Campbell's soup example. Flipping a house it is taxed the same way as Campbell's soup making a can of soup. Literally the same exact way. It's inventory. It sits there. And when you sell it, you get to you pay tax on it, just like a can of soup at Publix or at your supermarket. That's just how it works.
Okay. Very good.
Crazy, right?
Let's talk about depreciation, because I think that this word depreciation gets a lot of people confused as to what it is and how it works and how we can take advantage of depreciation in real estate.
So it's also something where I find the biggest area of contention between CPAs, finance people, and real estate investors, because depreciation has nothing to do with cash. And when you're trying to do your return on a property, your cash on cash return is completely different than your tax return.
Yeah.
And it drives everyone nuts. But here's what depreciation is, right? So if I am wearing AirPods, when I buy this AirPod item, I get to depreciate it. I get to write off the cost of buying this for my business over a period of time. Well, the same thing works with a house, right? When we buy a house or a commercial property, we buy this property and we get to write it off over a certain number of years. That write-off is called depreciation. It's just that simple. Now, there's a lot of other little pieces that go into it, right? We can't write off the cost of land. So if we buy a building for $1 million and we say 200 grand is for the land, I don't get to write off the 200 because in the world of the IRS, land doesn't go away. It just sits there. But the building's going to deteriorate. Well, for how long? The IRS says 39 years. So we get to write it off over 39 years. If it's a rental property, it's 27 and a half years.
Right.
So there's
So
different lives that go with it.
basically residential versus commercial. So residential is 27, commercial is 39.
Correct. Yeah. And there's other things in there too. If you buy a refrigerator or you buy other stuff. For people on the residential side, that's it. There's nothing else you really can do. If you're on the commercial side, there's these really cool things called cost segregation studies that we do, where we say you bought that building for $1 million, but did you really buy a building or did you buy walls and paint and carpet and asphalt and all this other stuff? And we do these studies where we say, cool, that 800 grand, only 400 grand of it's really for the building structure. The rest of it's 5, 7, and 15-year property, which we get to write off at 100% in year one. So that's where the power is on the commercial side of being able to take all this depreciation and go, and we expense it all right when we buy the building. It's beautiful. And cost seg studies are very cheap to get that done.
Okay, so I think
apartment units too. We can use apartments as the same example to bring it home on that side as well. It works the same way.
Okay. So I think let's take like a quick example, like a simple example of how depreciation on a single family home that we bought is going to lower our tax bill.
So let's say, for lack of math, let's say that we calculated and we have $1,000 a year that we get to write off in depreciation. If we're in the 20% tax bracket, that means we're writing off $200 a year in income taxes because we bought that home against our income. So it's $200 in pure tax or $1,000 in profit. So if you're charging that $10,000 to $1,000 a month in rent, the first month's rent is non-taxable. You just got it. So it's a direct offset of what you're paying taxes on, which is beautiful. Cool. And the more properties you own, the more depreciation obviously you have. Does that kind of make sense? I want to make sure I drive it home and I do it the right way that you're looking for on that.
Yeah, it makes sense to me. But you guys remember, this is all going to be in the show notes too. So if you need to like go back to the notes, it's all going to be in there.
That, and then I'll give you the link at the end. We actually created a little landing page for you, for everyone listening, that they can come and ask us questions on there too. So that we'll actually notes from you guys and we'll actually answer them for you as well. So if you have any questions about it, we'll do that for you too.
Fancy. I like it.
We try to help you out.
All right. So we talked about what an installment sale is. What if I refinance an investment property and I take money, I do a cash out refi? Yep. How is that going to be taxed?
This like gave me like my hair stood up when I read this question, because this is one of those it depends answers, which I know people hate. Here's the key. When you refi properties and take cash out, it depends on how the structure is set up around that property. Is it an LLC? Is it an S corp? How is the entity taxed? All that plays in. So if you simply refi the property and keep the money in whatever it's titled to, so if it's titled to Carrie Like in your own name and you take the money, you should have no tax problems. But if it's titled as Carrie Like Inc., Carrie Like Inc. gets the money, and then if you take the money out to yourself, there could be a tax issue, but maybe not. It all plays down to basis. And this is why it gets complicated. It has nothing to do with the property. It has everything to do with the ownership structure. This is why we always tell everyone, own your real estate in partnerships. If you own it in a partnership or an LLC taxed as a partnership, there should be no tax problems with it whatsoever. There's always a case there is, but for most people, there's no tax issue whatsoever. So if you, with proper planning, proper structure, you refi a property, you take the money out, it's yours. We see it happen time and time again. And on the bigger deals, that's the whole reason you do it, right? We buy a property and we sell it to the bank over and over and over again to suck out as much money as we can. And all that money's tax-free.
And the reason it's not taxed is because technically it's a loan, correct?
It's a loan. And for a partnership, the loan is secured by real estate. And the tax code loves when loans are secured by real estate. And because it's secured by real estate, what they say is the real estate's acting as collateral, even though you're personally guaranteed it if you are. So you get to keep the money. It's yours. It's beautiful.
And does it matter what that money is used for?
Nope, it's yours. You can use it for whatever you want to. Hopefully, if you're taking the money out, you're not using it to go play with. You're using it to go reinvest, and we're using economies of scale. But, hopefully you're taking a little bit out to have some fun with and congratulate yourself for doing that deal too. Or paying off a hard money lender because you were able to get a bank financing loan on the thing afterwards, right?
Right. So you said something in there, and let's dive a little bit deeper into business structure versus tax structure. So I might have an LLC, but it's taxed differently than an LLC. Might be taxed as an S corp.
Correct. LLCs are the most useful tools possible, and they're the most confusing things ever for most people. LLCs can be taxed however you want them to be. If it's one owner, they're disregarded. They could be a C corp or they could be a S corp. If there's two owners, it can be a partnership. It just, you don't know. The harder part is most businesses will ask, are you an LLC or an S corp? Further confusing this whole issue.
Right, because it could be both. It's an LLC that's taxed as an S corp.
I usually, when I have those papers, I handwrite in, this is wrong, and I cross it out because I get so mad because I have my geeky CPA hat on and I rewrite the question for the people. They don't like me for that, but I do it. So, but yeah, no. So here's the answer.
It matters, right? It matters how you ask the question.
100%. And it's why it gets so confusing. Florida's notorious for doing this. And most legal docs in Florida, they ask, are you an LLC or S corp? I think your question, though, is when you're structuring these things, does it matter? And, from an operational standpoint, it probably does if you talk to your attorney. From a tax standpoint, we usually don't care as long as it's all in the same bucket, but there's some tax planning things if we do them differently. And there's other reasons along the way. So this is one of those things where you really need to have a good CPA that understands enough about the law to explain that piece to you. Without acting like a lawyer, because we're not lawyers, right? And a lot of us like to act like we're lawyers. You have to have a good lawyer too that's involved to help you structure these things. But typically what we do is we say, put all your active businesses in one bucket or multiple buckets over here. And we put all of my hands are like here, and put all your real estate rental properties in another bucket. The one bucket where you have your active, so your flipping business, if you're a realtor, your realtor income, your wholesaling, whatever, you can put that in multiple companies if you want, but we want those all in one area, and we want that taxed as an S corp. We want all your rentals in a separate bucket. And underneath that bucket could be land trust, it could be other LLCs, whatever you plan to do. We've seen them both done, and it doesn't matter from a tax perspective. We want all of those rentals in its own bucket and separate. Why? Because they're taxed differently. But more importantly, if you're ever audited, we want to be able to fight for you and say, no. The things over here should be taxed like this, and the things over here should be taxed like this. Go away, Iras. So that's one of those things where from a normal standpoint, we don't care if it's all in one bucket. But operationally, keeping them separate really sets yourself up for protection if you're ever audited. And I say everyone gets audited at some point. It's just a normal course of life. We just want to make sure we minimize that to a little letter where they go, please explain this. And we go, here's the answer. Go away. Go pick on Jeff Bezos. Go pick on someone else.
So this gets back to our the explanation of that first question, ordinary income versus long-term capital gains, is you have this working bucket. You say it's a working bucket. So that's your flips, that's your wholesale, maybe your listing agreements. That's all going to be taxed on ordinary income. Correct. And then you've got this other bucket that's holding your long-term assets, and that's going to be taxed as long-term capital gains. So that's why you want them in two separate buckets.
Correct. Upon the sale, right? So if you're renting properties and you're earning income, that income is still taxed at ordinary, but it's the sale piece that's taxed at that other piece. And on the ordinary side, again, you might not want to have, this is where the lawyer hat comes on, right? You might not want to have your wholesaling and your flipping business in the same entity. They might want them separate. Yeah. Some banks don't like to see complicated structures. They looks like an octopus and they go crazy. That's stuff that we don't care as long as it's separate from those rental properties. We always want those long-term assets completely separate, especially for real estate investors, because the IRS loves you guys when everything gets messed up in there, and they'll attack if they can. Yeah.
And why do you prefer S corp for the working bucket?
So
and maybe I don't know if this is a complicated question and a complicated answer. Okay.
No, it's not. So if you're just an LLC that's a sole proprietor or a partnership, there's a layer in there called self-employment tax. So if you're a W-2 employee, you get payroll taxes taken out of your paycheck. right? It's half of 15.3%. But if you're working for yourself, you got to pay the whole 15.3%. And so if you flip the house in your own name, you're going to get taxed on top of, by the way, on top of that 40% rate. If you're in the top tax bracket, another 15.3% on top of that. It's crazy.
So there's
you're going to get hit.
Over half of your paycheck is gone.
And that's if you're in Florida. If you're in another state that has a 10% tax rate on top of that, now you're looking at 60 something percent. It's unreal. So what we do is we want to figure out a way to make sure you don't get hit with that extra 15.3%. S Corps. So if you take that income and put it into an S Corp, there's no 15.3% tax. It just goes away. Now, everyone's going to go, well, why don't we do that? You probably already do. And if you don't, there's another piece to it because, right, you can't have your cake and eat it too. The IRS wants you. If you have an S Corp, you have to pay yourself a salary. The salary is subject to the 15.3%. The key is figuring out how much to pay yourself to get it as low as possible without the IRS coming after you. That's why we want an S Corp, though, because we want to manage that 15.3%, which is even now more important if you're paying yourself over 400 grand. Who wants to do that? Let's get out of that so we don't have to pay all that extra cash, right?
Right.
It's a big deal.
Yeah.
Does that make sense?
Okay. Yes. And I think this goes back to Alicia's question. She said, do I need to fill out a form 8832 to convert an LLC to be taxed as an S Corp? As
a corporation. I want to say I think yes, but here's the key. You really want to understand what you're doing because when you switch entity types, so if you're an S Corp going to a C Corp or C to an S and all this other stuff, there's different rules out there about the big tax. It's called the built-in gains tax. And there's other things out there. A lot of times what we do, instead of changing an entity type, we create a brand new company and we slowly move operations in a really careful fashion so the IRS doesn't question what we did over to that new company. This is one of those, it depends what assets are sitting inside that thing. So usually, yes, that sounds correct, but you really need to talk with your CPA about that. I never recommend people make tax elections without talking to their CPA. And again, if you have a really good CPA, like what we do with our clients is if you can do something yourself, and Carrie, you've known me a long time, I'll go, why are you going to pay me to do that? Go do it yourself. I mean, it's really simple. This is where you go and this is where you do it. I'm going to charge you a lot more money to do that. And there's other stuff that I'll say, there's no way in hell you're going to do that, Carrie. Come talk to me. We're doing that because if you check off the wrong box, it's going to mess up everything. And we don't want that.
Right. Okay. So, Alicia, I hope that answered your question. And if it didn't, you can always contact Sean.
Yep.
Yeah.
Definitely.
Okay. All right. Okay. So what is, I love this question. What's the difference between a CPA like HR Block versus a CPA like Sean? I just always think of HR Block as like,
green visor guy.
Yeah, like the Walmart of like retail. I don't know. It's like
So it's hilarious, but you know what? Here's the key. You know, again, like everything has a purpose.
Yeah.
If you don't have a super complex tax world, TurboTax and H&R Block, or Jackson Hewitt, all those places are just fine. It's when you start having multiple entities and multiple deals, and when you start having this thing where you have to be thinking about the 14 other things when you're being asked that one question, that's where having a really good CPA starts coming handy. For instance, the question we were talking earlier, if you ask an H&R Block person about deal one, they're going to tell you the answer for deal one. They're not going to say, by the way, don't forget your son owns 1% of that company. And when you do this, it's going to cause an issue with his college education, free funding, whatever thing. That's where having a really good CPA that comes in handy that goes, okay, I know about this one piece, but I know your whole world, and I can advise you on that whole world and really give you answers that help with everything, not just that one area. The other thing that I've learned with some of these places is they try to do everything for everybody. And again, when you work with really good professional advisors, they should be telling you, I have no clue how to do that. That's not my cup of tea. It's not what I do. I know someone, and I'll let you talk with them, or I'll meet with both of you to answer that question. People at H&R Block and Jackson Hewitt, they're not trained to do stuff like that. They're trained to give you an answer and hope it's right. And then my last point, I always love this one, is they're usually not CPAs. They're usually an enrolled agent, which is not a CPA, or they're just a tax preparer. Tax preparers don't have to have a CPA license. So you don't know what you're really getting. A CPA, yeah, we have 4 years of regular college. We have another 2 years of master's program. In Florida, we take 4 really big tests that are a pain in the butt, and then we do 80 hours every 2 years of continuing education. Yeah. Everyone doesn't have that requirement.
Yeah. And I will say, big difference. It's really important to find a CPA who has experience in real estate, because there are really
Yes.
good CPAs out there that don't necessarily work with a lot of real estate investors who are doing these complex deals. And so for me, it was important to find someone who also invests in real estate, they're also doing similar deals to what I'm doing, because they're going to know better than anyone, because they're doing their own taxes on their own real estate deals.
Yep. Yeah, no, 100% accurate. And then again, this is a great one for this, is the self-directed 401ks and self-directed IRAs. A lot of people in the real estate world play with this. A lot of even real estate CPAs don't touch those things.
Mm-hmm.
The good ones won't touch them. The bad ones won't. We actually just had a case recently. We had 2 different ones with different CPAs in different cities in Florida, where they helped a client with this, transferring their assets into a self-directed account. And the IRS got wind of it and didn't like it. And the CPAs didn't respond to the IRS correctly. And now this simple thing that could have taken someone like us that works with self-directed. I mean, I have my own self-directed 401k, right? So I know how to use them. They wrote a letter that wasn't right to the IRS. And now we're in this back and forth where the person has probably paid 10 times what they should have to get this thing resolved. And It just drives me crazy, because I was like, man, I wish that CPA just would have called someone or just asked somebody, because they could have told them, don't give them that piece of paper. Here's what you say. It's all about the words.
That's interesting. I think the way we found you was that we were doing more deals out of our IRA account, and our CPA didn't understand IRA transactions. And we had reached out to our IRA custodian and we said, hey, we need a CPA who's going to understand these transactions that we're doing. And they had referred us to you. And I think that's how we ended up meeting.
That sounds, it was probably through Austin is what I'm guessing, but yeah.
Yes. Okay. So
that's hilarious. Yep. There you go. It's funny.
All right. Okay. So we talked a little bit about this, but what do deductions do for taxpayers, and what are some common deductions that we can take in our real estate business?
So deductions lower our taxable income, right? So for every dollar that we deduct, it's not a dollar less of tax, but it's a dollar less of the base that we're taxed on. So if we're in the 20% tax bracket, every dollar deduction gets us 20 cents off our tax bill. Simple, right? Here's the fun one. For deductions, if you want an active business, so put rental properties aside, if we're flipping or a realtor or any of that stuff, if you're eating, drinking, sleeping, thinking about your business, it's tax deductible. So think about that. It's literally everything you're doing. So an exercise we do with our new entrepreneurs or new owners is I say, walk me through your day. And they get really mad because I make them start up with the moment they open their eyes and like literally walk me through their day. And they get so upset. And then I'm like, they're like, okay. And I put on my watch and I'm like, oh, who owns your watch? And they're like, what do you mean? It's an Apple Watch. And I go, yeah, but that's for the business because you get text messages on that. And they go, oh. And I go, you're using your phone. Who owns your phone? And you put on that backpack. Who owns that really nice leather backpack? I mean, that's an ordinary business expense for a taxpayer. You start figuring out there's a lot of stuff out there that you can deduct. My favorite is meals. Bigger reason. So the old rule for meals last year, 2 years ago, was 50% of your meals were tax deductible. So for every $10 you spent, you got a $5 deduction. Right now, because of the pandemic, 100% of all meals that are eaten at a restaurant or a place that's a restaurant, so you can get takeout from the restaurant, those are 100% tax deductible. Mm-hmm. So it's amazing how much you can get. I don't know if you order from DoorDash from a sit-down restaurant, is that qualified? My guess is it is, but there might be some gray area in there, and who knows? We probably won't find out for a couple of years. But I mean, I like the gray area. I'd say go for it. But that's the biggest deduction that you can get. Another one that I find from realtors often is, I'll go, well, don't you drink a cup of coffee when you're on the road all day long? And they're like, yeah, I stop by Starbucks like 3 times a day. And I'm like, why aren't you writing that off? And they're like, I can do that, but I didn't take a client. Yes, you were thinking about your business when you were there. Of course you can write it off. Does that make sense?
Yeah. Well, and also gas mileage on the car.
Everything for the car. So the cars are really funny. You can take mileage or you can take the actual ownership cost of the car, whichever is greater. We've found usually if you're buying a new car, it's cheaper to write off the whole car. The fun part though is you still get to write off all of the service fees, all of the not mileage, all the service fees, all the gas, all of that stuff that goes into it. So it's great. Caveat on vehicles. If you own one vehicle and you use it for personal use and for business use, you're supposed to keep a mileage log. I don't know anyone who does that, but you're supposed to keep a mileage log. There's lots of cool apps out there that do it. Carrie laughed, but it's true. I mean, I don't know who keeps
I
mileage
tried.
logs.
I
It's
don't
terrible.
know if
I
you
did too.
remember, but I tried to keep a mileage log. I had like this piece of paper up on the dashboard that had like, and
No.
every time I would stop, I'd write it in. But when you have kids and business, I'm in and out of my car like 5, 6, 7 times a day. And so I would get to the end of the day and I'm like, oh crap, I forgot to write up my mileage log. And Howie, my husband, he was like, oh my God, you were never going to keep track of this mileage log. And we had a bet going on how long I would last before I just chucked the mileage log. And it lasted like 5 days. And I was like, I can't do this. And so that's when we found an app that will track our mileage. And
there's a lot of cool apps where you can just swipe left or right if it was business or personal. And that doesn't change if you're taking mileage or taking the actual car deduction. All we're trying to get is what percentage of the vehicle was used for personal versus business. Now, in the real world, most people write off 100% of their cars. The reality is you're not supposed to do that. You're supposed to write off a piece and a piece. As CPAs, we have to ask the questions and get comfortable that you're doing the right thing and advise you on the right answers. But that's how cars work with that. So it's really a fun thing. Also, fun fact, cars, usually you get a nice big write-off up front. So if you're thinking about buying a car next year, mind you, don't do this if you don't need a car, but if you're thinking about buying a car next year, you can buy it this year in December, usually when there's good deals happening, finance the car. The rates are like 2% or less, depending on where you're going through, and it's simple interest. And then you get that huge tax deduction with borrowed money. It's kind of a win-win right there. Vehicles are a great way to lower your taxes. And if you're a real estate investor and doing all these different types of deals, you're pounding pavement and you're in your car. You can write off that vehicle. It's a huge place. And good.
It's so funny. Alicia, who's listening to us right now, says, I do a mileage log, LOL.
That's awesome.
How do you do that? It's like,
that's awesome. Is it in paper or is it a digital? I did the digital one for a year. I was good for 1 year and then it was just so difficult. But I'm really good about my calendar and calendaring everywhere I am. So if I have to recreate one, I can go back and recreate the whole thing.
That's true. My calendar, I could look back on like the last 5 years of my life and know exactly what I did at 12 o'clock on like January 3rd, 2000 and like, I'm
the same way. I tell everyone, I'm like, just put it on my calendar and I promise wherever it is, I will show up. But if you tell me to remember it, I'm going to forget 3 minutes later. So Google Maps in your timeline does that for you. There you go. See, I don't want Google knowing where I'm going though. They make me too scared of the stuff they advertise to me then.
So to recap, you can't take both your mileage and...
You can't take mileage and actual cost of a vehicle. If you take actual cost, you still get gas and service and all that other stuff. If you do mileage, it encompasses everything, so you only get that. There's complicated rules with it. Ask your CPA what the best option is and make sure they explain to you what they're doing and why they're doing it. So that's always a good helpful thing. Also, if you have multiple cars in your household, tell your CPA about all those cars too. They might help you figure out a way to really get some nice deductions there as well. The other one that we get a lot of is, I went on vacation, can I write off my vacation? Right. So, and I always go, it's a vacation and it's for personal, so no. But if you're like any business owner, chances are you're going to go, but I was working the entire time. It's probably still no if you're on the beach. But here's the fun one, right? If you go, I don't know, we're in Orlando. If you go to Cocoa Beach and get a hotel room for 4 days and, Howie and the kids just happen to come with you, and every day you spend a good part of the day out on the road looking at houses and properties and stuff over there, and Howie and the kids are playing on the beach, well, I mean, technically, you probably could write off that trip, not the portion for Howie and the kids, but you probably write off the hotel room, the car ride, because you are working and you have documentation that you are. The IRS is a lot like a company that needs to be marketed to. If you're ever audited and all this stuff, you just need to show that you did what you're supposed to do. 9 times out of 10, they back down. It's the person that can't answer every question or doesn't have a CPA answering every question that gets in trouble. Yeah. Because they don't have the documentation and the agent gets scared and says, there's something else here. For a person that goes, here's my mileage log, or here's pictures of all the properties I looked at, or here's whatever else. Oh, but you brought Howie and the kids with you. Well, yeah, they tagged along, but I would have spent the same amount of money on the hotel and the car. And by the way, all their food and stuff I never deducted because I wasn't supposed to. Yeah. Oh, okay, Carrie. Bye-bye. I can't do anything.
Yeah. This is why it's great to have events on cruises. Like if you do a cruise event where they're having like a real estate event. I know Robert Kiyosaki does a cruise because technically you can write off the whole thing if you're at the event a certain percentage of the time.
International travel works the same way, and I don't know the timeline off the top of my head, but there's like rules surrounding the number of days and everything else. Not many people follow the rules. Not many people know there are rules. My whole thing, again, is just make sure you're doing, you can't have your cake and eat it too. It's the ones that get overly aggressive with tax deductions that get in trouble. The ones that actually follow the rules and don't try to stretch it to the nth degree, they usually are just fine. And if you haven't noticed, I love fighting the IRS. Like, I just love getting in their faces with all this stuff, respectfully with them, because a lot of times they're off basis. And it drives me crazy when it's that one taxpayer that just, they did everything they should have and the IRS came after them, you know?
Yeah.
We have a lady that's a client of ours that came in. She's an individual. Her husband was a fighter pilot in one of the World War II, I believe. And the IRS was like attacking her over something because someone did her taxes wrong. And I like lost it. And it was just like, are you kidding me? And just like took care of the whole thing for her. And it was something so simple. It was, that drives me nuts. Anyway.
I could see you in your office like,
I get so mad. I get mad when people are taken advantage of, you know, or they shouldn't have been. So she was definitely taken advantage of by who did her taxes. And then the IRS was messing with it. And then the other people couldn't answer the IRS's questions, which, you know, the IRS is all rotor. It's all this computers are just sending out this stuff. And I'm just losing my shit in the middle of the whole thing. So.
Yeah, I've seen it. So I know. I've seen it firsthand with a couple of things that you've handled for us in the past.
Yeah, you want people that are going to fight for you and that aren't going to back down and that aren't going to say to you, no, the IRS was right. Sorry. You know, you don't want a CPA like that, but you do want them to say, yes, the IRS was right. And here's why. But I think we might be able to explain this little thing and get you out of this whole mess because they still messed up. Yeah. You know, that's the person you want to figure out the whole thing because we still want to paint within the lines, right? No one wants to go to jail. You guys don't. I don't. Let's do what we're supposed to do, but let's paint within the copy of the code and what it says. Yeah. And if you're a client of ours, you'll probably get a copy of it stuffed inside of, you know, something we send you eventually. So there you go.
Yeah. All right. So we talked a little bit about this with the refi, but let's talk about home equity loans and what are the tax benefits of taking out a home equity loan?
None until at least 2026. So in the current rules, you don't get to deduct home equity loans anymore. Now, I will say ask your CPA. There's a caveat in there. And the caveat was under the old rules that if you took a home equity loan, so this is pre-2017 before the Trump tax plan was put into place, you're able to, if you could trace the cash to like a business deal, you're able to write it off. Or if you use it for anything, you could write it off. So the old rule was up to 100 grand in home equity, write that sucker off on your taxes. Great. Perfect. New rules, you don't get to write it off at all. The reason this came about, in my opinion, is they knew people were taking home equity loans and using them for things that were personal in nature, and they didn't want to give a tax deduction for personal items. A long time ago, like prior, you know, back in the 80s, you actually used to be able to deduct credit card interest on your taxes. This is the same thing they're trying to circumvent. They didn't want you to deduct home equity loans being used for personal things, the same as with the credit cards.
Right. So why is 2026?
Because that's when the 2027 tax law sunsets. So unless Biden changes that, probably won't. Unless that gets changed, it's going to sit until 2026, then it automatically goes away. And then it comes back to what the old rules were. So a lot of these tax things, and I don't, you know, I should know all this legal stuff, but the legal stuff just bores me on a lot of this stuff. But most of these tax plans, they have to have them set for a certain period of time and they have to go away. And because of how they do that, it's going to happen for a certain period of time and go away. The estate tax is a perfect example of that. If you actually look at the rules for the estate tax, the original estate tax is still in play. It's that they change the amounts every year because they always vote on that change. But if they don't vote on it, it goes away to another plan that was already there before that. So it gets really complicated on that stuff. I mean, it's why I have a job, but I hate how complicated it gets.
Yeah. I don't know how just all of this just can get so complicated and complex and it's changing all the time. I don't know how you keep up with it.
You know, for me, it's a lot of education, but it's a lot of people like you going, what do I do? And me going, oh, crap, I got to read that whole pamphlet about how that thing works. But, you know, for me, I'm fascinated about it because I feel like, you know, and you know my history, I've worked with really big, high net worth groups. And directly for families and whatnot. And I loved every minute of it. But how do you take what a company or a family that's worth, $3, $4, $5, $6, $700 million and take those big things that they do and bring it down home to what you do every day, right? You can't write a check for every single thing, right? A big company can write a check and make a $10,000 issue go away. You and me might go, I don't want to go put 10 grand on my credit card, or I don't want to go do this. How can we help that person navigate through that? Mm-hmm. For me, that's what keeps me going. I loved figuring that stuff out, and I love doing that piece of it.
Yeah.
I'm also really fidgety, so you're right. I don't know how I sit still long enough to actually talk about this stuff.
You must have like a treadmill in your office. You're like doing taxes while you're running.
I'm playing with something as I'm underneath my hands as we're talking.
Oh my gosh. I'm going to get you like a whole like stress ball collection for Christmas, I think, next year.
That'd be great.
Sit there and like.
I would love it. I would love it. Make sure they're orange and teal. That would make me so happy.
All right, I will. All right. So I think just as a recap, basically, what are the most common ways we can offset our taxes using real estate?
So I think the most common way, and it's no rocket science, is really the depreciation factor, right? For rental properties, right? For rental properties, it's all of that stuff. I will caveat everybody on rentals, and I had this happen with a lot of clients that worked with banks. Hard money lenders are completely different. With banks, they don't like seeing a lot of write-offs against rentals because it kills your NOI, and that's what they're looking at, your net operating income, to determine, or operating income, depending on how you define it, to determine how much money they're going to loan you. So I've seen that happen a lot there, just as that little caveat. But for real estate, it's like any other business, right? It's we want to write off, we want to write off, we want to write off. It's usually through depreciation. It's usually making sure in contracts and agreements we're documenting what we're purchasing and how we're purchasing it. I can't tell you how many times I've seen someone go, well, I've got all the furniture inside the house. And I go, the agreement doesn't say that. So sorry, we can't write all that stuff off. But if you just would have taken the purchase price and split it in the agreement, you could have kept it the same on the HUD. I could care less. But if you had an agreement somewhere that said how much you were buying, I could give you better tax deductions, tax planning, right? Those are the big pieces. If you start venturing into the commercial world, or buying, 4 or 5 plus door apartment buildings, cost segregation studies are the number one way to really lower your taxes in that area. It's crazy. And obviously I love them a lot.
Oh, man. All right. Well, we're up to an hour here, and I think this was all great information. But if people want to get in contact with you, we've got a few people who I think want to reach out to you. What's the best way to do that?
So go to DimercurioAdvisors.com, and I'm sure you'll put that in the notes so that people can actually spell my name correctly. And then actually, if you go /warrior, it's a landing page created just for your viewers and just for your podcast listeners that can go in there and actually ask us any questions they have. I'm sure we're going to throw a copy of this on there too, but yeah, they can go in there and ask us whatever questions they have, and we'll be more than happy to do that.
You said Dimercurio Associates.com /warriors.
Advisors, DimercurioAdvisors.com.
I knew that.
It's okay. I'll hold it against you one day.
Dimercurio, which is seriously the hardest name to spell. I can never spell it right. I always have to look. So and I've known you now for how many years that I still the first time I write your last name, I always write it wrong.
We laugh with our team because I said everyone that comes works for us will always know how to spell our last name now because it's now part of everyone's email addresses. And then all of our marketing companies are screaming that all of our marketing friends are like, that name is too long. We can't type that name in.
Well, it's long, but it can also be spelled D, like the D is D-I, It could be D-E, and then Mercurio could be M-E-R, but it's actually M-U-R. I always inevitably spell it wrong. So DimercurioAdvisors.com /warriors with an S.
Warrior, no S.
Warrior. I'm going to get this right eventually. All right.
You are. It's okay. I'll email it to you after.
Yeah, I'm going to add it to the banner here, you guys. So if you're on the live stream, you can see it.
Oh, no, that's not right, though.
It's not right.
No. Dimer. Carrie.
Oh my gosh. Dim. This is what I'm talking about. Dimer. Mercurio. Hardest name in the world to spell. Most awesome CPA in the world to deal with.
My Italian heritage.
All right. So you guys, it's up on the banner.
I love it.
Right? All right.
You got it right. I love it.
It's up on the banner right now, DMercurioAdvisors.com/warrior. You are located in Orlando, so you can also Google them, Dimercurio Advisors. And if you're listening to this on the podcast and you were like, how the hell do you spell that last name? Like I always ask myself, you can go to the show notes and it will be there. We always have fun.
I do. I don't think I've laughed this much in a while. I'm glad we got to chat for sure.
Who knew tax planning could be so fun?
If you do it right, it's really, really fun. We actually had lunch with a client last week and we laughed for like 2 hours at a restaurant and everyone's like, what do you guys do? And they're like, we're just having drinks with our CPA, figuring out our taxes. And they're all like, what? I'm like, don't worry about it. Go away. We're having fun.
No, it is fun. And what I love about it is you can get really creative and proactive and you get productive around it. So definitely need to have a good CPA who knows real estate on your team if you're going to be investing in real estate, guys. Okay. So DMercurioAdvisors.com/warrior. Go to the show notes for the spelling of Sean's name. Or if you're on YouTube here, you can see it up on the banner. So thank you, Sean, so much for coming on and spending this hour with us and our listeners.
You're welcome. Thank you for having me. This is great.
Yeah, this is cool. We're going to have you come back on once these changes do go into effect to talk about how this is going to affect the current real estate investors out there.
I would love to. That'd be great.
Yeah. All right, you guys, we will see you on the next episode. Take care. And remember, you are just one deal away.